Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is DaVita Healthcare Partners, ticker DVA. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, we look at the market cap. It is a $7.5 billion company, enterprise value of $16.2 billion. This suggests an extreme amount of leverage on this business, that you have more debt covering the enterprise value than you do market cap. That's relatively rare, so it's extremely leveraged, something to be aware of as a potential investor. The industry is the healthcare provider and services industry, which tends to be a fairly good industry, but we will see how that plays out in the business description. So DaVita provides kidney dialysis services for patients suffering from chronic kidney failure. They operate dialysis centers, provide related lab services, and outpatient dialysis centers. So it looks like they provide services to about 16,000 patients, 7,000 patients there. They have a network of 2,800 outpatient dialysis centers serving 203,000 patients across the United States, and it has services within 850 hospitals. So pretty diversely gone throughout the United States. It's a very large number of patients and dialysis centers, so pretty diversified there across geography, I would assume. Return on invested capital. One of the first things I like to see is 20 straight years of profits for high quality companies, and that's exactly what we see here. There's not a single loss in the last 20 years, a very good sign for potential return to investors. However, you do see some negatives as well. You start out in 2002, 2003 above this 10% return on invested threshold, which is what I like to see. I want my investments to be above this 10% line. But we can see that only 3 years out of the last 20 years have they been above that line. Instead, starting in 2005, they dropped below 10% return on invested capital and have hovered, basically peaking at 7% since then in 2009. So you see 6%, 5%, 6%, 6%, 7%. So you get that 7% number, and then you're up to 6% in 2021, but otherwise you've been pretty low. I don't really like that. This is more of an indication of a lower quality company, average company, not being able to maintain that 10% plus return on invested capital. However, it is again in favor that they've avoided having any losses. So even when they have down years like 2015 and 2018, they're still making money that is good over the long haul, and it looks like maybe they're recovering a little bit. This part out here, of course, is a little less encouraging. Now, due to that extreme leverage, they're turning this 5% 10-year median return on invested capital of 4.9% into a return on equity of 13.9%. That is very impressive. So their ability to use a lot of leverage is boosting that return on equity to allow shareholders to get a much more respectable rate of return. Otherwise, over the long haul, you generally expect your returns to tend towards either return on equity or return on invested capital. And so you'd much rather have this 14% number than this 5% number. And again, that's that intelligent use of debt. Now, from a valuation standpoint, PE of 9 is actually really attractive. I like to buy stocks with a PE of 15 or less. PE of 9 is a very good number to hit. Anytime you're below 10, you start to definitely get in the undervalued territory. So it's looking like DaVita might be quite undervalued at this current price. So that gets really, really interesting. Let's look at the 10-year CAGR numbers. Now, one of the things we see here is, of course, these lower returns over the last decade, pretty stagnant here. That's why your assets and return on revenue are pretty similar here, but the assets growing faster than revenue does lead to some of that decline over time, especially compared to free cash flow and revenue. Now, EPS has been growing faster than both revenue, free cash flow, and assets. That could be due to buybacks, could also be due to this leveraging effect of debt, and we'll just have to see as we dive in deeper. Now you can see that EPS here, of course, growing really fast from $2.74 to $8.90, but that is despite the fact that revenue is basically flat from 2013 to 2021. So you can see the business model leverage here in those numbers. So I want to see that growth. You can see that the growth is uneven. That's why you get these ups and downs. In 2015, you collapsed your earnings, and in 2018, you collapsed your earnings. I don't like these big negative ups and downs. It makes it very hard to predict the future. Something to be aware of as we go further. If you're enjoying this video so far, please hit that like button. Don't forget to subscribe, ring the bell. Your likes, subscriptions really help YouTube know that you are enjoying the content, so I would really appreciate it. Now, let's go to the income statement. SG&A is up about 30%, but again, basically SG&A is growing in line with gross profits, so that's all good. But again, you're basically flat since 2021. From 2013 to 2021, they're basically maintaining where they're at. But again, I was definitely right. The big difference here is share buybacks. Look at this outstanding share buybacks. Starting in 2013, you had 215 million shares outstanding. You end the decade at 110 million shares outstanding. This is a massive share buyback over the course of the decade. You've taken 50% of the shares outstanding out of the market. So this is how they were able to not even double net income. Look, you've gone from 536 million to 978 million. You didn't even double net income, but you basically tripled your earnings per share. And it's all because they've bought back so many shares. Very, very good, intelligent capital allocation there. I like what I'm seeing. Now let's see the balance sheet. Again, well, first of all, let me just go back to the interview. That's what the overview. That's what's happening. You turn revenue growth of 5% into EPS growth of 13% by having those massive buybacks. This is why buybacks are so helpful for investors. Accounts receivable up about 50%. You have 4x your PP&E, which is a little high, and it's probably going to come with some extra debt. And you have seen that they've doubled their debt. Look, so you can see $8.7 billion in debt, and our equity here was $7.5 billion. So you have more debt than you do equity in the business. So very, very leveraged, especially when you compare it to the shareholders' equity from a balance sheet standpoint. $8.7 billion in debt, $2.3 billion in shareholders' equity, especially when you also add in these capital leases. Very, very leveraged business. The only way they're making this work is they're able to get that debt at low interest rates. If interest rates rise, that is a threat to this business model, so you need to be aware of it. Now, you do have pretty decent amount of depreciation and amortization, and that is with their continued investments in PP&E. Looks like they're making some small acquisitions steadily over time, so something to be aware of, keep into account. But these absolute massive net issuance of common stock. And what you're really seeing is they're buying back more common stock than they are earning in net income, or at least it's about 100%. Yeah, in some years, more than they're earning in net income is being used to buy back stock, and that's being managed by issuing more debt. So over the last 7 years, they've really leveraged up the business. They've really pushed everything they can get out of this from a balance sheet and financing standpoint, and it's paid off very well for shareholders. So I assume the shareholder returns have been very good over the last decade. The question is, can it be sustained over the long term? You struggle when you have a return on invested capital in the 5 and 6% range, because it means you're going to need debt to get your return on equity up high enough. I like to see return on equity of 15% plus. I like to see return on invested capital of 10% plus, because normally you can easily turn 10% return on invested capital to 15% return on equity. In this case, they've taken a 5% return on invested capital, and they've almost reached my 15% return on equity target. And they've done that from very high leverage. But you can see if you just look over the last 3 years, you're at the return on equity target, 19%, 24%, 37%. Very, very good numbers here. But it looks like the overall long-term growth of this business is a little questionable. If we just go from 2013 to 2021, you're not growing very strongly on revenue. And so for me, that would be the key thing, combined with this low return on equity, that would keep me away from the business. But I think there's a lot of good stuff here. So if you're an investor in this business, I certainly understand why. Anytime you can have good capital allocation, focusing on buybacks, able to grow these EPS in double-digit rates, you're going to get very good returns. And so when you're able to grow at 13% a year, that means you're going to be trending towards 13% returns if you can get it at a reasonable valuation. And not only are you a reasonable valuation, at a PE of 9, this business is likely undervalued. So although I'm not investing in it today, and it's not going to go on my watch list because I don't hit my return on equity numbers, and I think these revenue numbers are likely to be lower in the next decade, I think it's a really interesting company that you can learn a lot from, and that could be interesting for someone that's trying to get a business in the healthcare space that they don't have already. So if you enjoyed this video, please hit that like button. Don't forget to subscribe. If you think that these are the type of videos that you find interesting, up here I'm going to have the S&P 500 playlist that I've been working through. I've already recorded over 120 S&P 500 stock analysis videos, and you can look at that whole playlist here. I'm working through the whole S&P 500, so you need to be a subscriber to check that out. If you like the way that I study these companies, if you want to do your own analysis using this software, I am using quickfs.net, and I have my affiliate link in the description below. If you use my affiliate link, it doesn't cost you anything. It doesn't cost you anything more. There's nothing extra surprise by using my link. It's just a way of supporting the show if you sign up after clicking my link. So you can sign up for a free or paid account for quickfs.net using my affiliate link, and that just gives me a commission by me having sent you to them. This is the software I use myself. I wouldn't recommend anything I don't use myself, so I hope you will consider checking it out. Thank you for listening, and until next time, stop paying fees, start building wealth.